Think about your investments as your items in your bedroom, in your pantry. If they're like this, would you still have the mood to manage them?
You don't take responsibility for your actions, and that's why this is all your fault.
So to build a simple, diversified portfolio can not only save your time, decrease your mental stress, but also can give you a good night's sleep. So in this video, let's look at this famous 3-fund portfolio method recommended by Bogleheads, and to see if we can mimic this by using ASX ETFs. And I'll backtest this portfolio to see some of its metrics. Hi, my name is Irene. Hit the like button if you heard of this 3-fund portfolio method. Now let's get started. To get the best outcome from active and passive investing, many investors adopt this core satellite approach when they construct their portfolio, and this strategy is also used by many large institutions. That includes Australia Sovereign Wealth Future Fund. So this core satellite approach involves to have the bulk of your investments sit in stable, low-risk holdings as your core investment to seek the market beta return, and have several smaller, high-risk holdings as the satellites to seek the alpha return. Generally, the core investment take up anywhere from 65% to 85%, so leaving the satellite investment take up from 15% to 35%. The good thing about this approach is if any satellite goes really badly, it's not big enough to hurt the overall value of your portfolio. In this video, we're only focusing on building the core investments by using the 3 funds. So this 3-fund portfolio is also called the lazy portfolio, which was recommended by an investing forum called Bogleheads to achieve the majesty of simplicity, John Bogle's phrase. And this portfolio is based on fundamental asset classes, stocks and bonds. So cash is not included. And the portfolio generally includes a domestic stock total market index fund, international stock total market index fund, and a local bond total market index fund. So by having these 3 funds, your portfolio will enjoy 3 benefits. First, by having an international stock fund and a domestic stock fund, your portfolio is diversified by countries. Second, you can control your currency risk by adjusting the asset allocation between these 2 stock market funds. And third, you can control your exposure to market risk between these 2 asset classes because bond is less volatile and you get a bit of both from the growth and the income. There are 3 simple steps to build this 3-fund portfolio. First, you're going to decide the asset allocation between stocks and bond. The starting point is to use the rule of 100, that you use 100 minus your age, and that gives you the percentage of stocks that you should be holding. For example, if you're 40, then you should hold 40% in bonds and 60% in stock. But this is a very conservative rule that leaves you less weight in stocks. That's why many people are using the rule of 110, the rule of 120. Not only people are living longer, but also the bond yield has been stubbornly low. Second step is to decide the asset allocation between international stock and domestic stock. Well, this 3-fund portfolio was recommended by the Bogleheads in the US, where the US stock market is very diverse and it has very similar risk profile as well as the long-term returns with the international stock market. So this question to the US investors is not that critical. The last step is to decide what funds that you're going to use as the building blocks to build this portfolio. Of course, you can use index managed funds or index ETFs. The key point here is to use low-cost index funds. Of course, the Vanguard funds will recommend to hold the funds directly with Vanguard, but in reality, you can use any of the index funds with any fund providers. In this video, to show my respect, I'm going to use Vanguard ETFs as my building blocks. But the ETFs that I'm going to choose are only examples. It shouldn't be taken as investment advice or recommendations. If you're interested in building your own 3-fund portfolio, I've got a pool of suitable funds from each bucket that I will list on my Patreon page. For my ASX 3-fund portfolio, I'm going to use John, a hypothetical person who is 40, following the rule of 110, so the total stock allocation for him will be 70%, bonds 30%. Between Australian and international stock markets, I'm going to give Australian stock markets a 25%, as Australian stock market is very concentrated in financials, materials, and consumer products, and John would like to expose follows more global diversified sectors, leaving international stock market to 45%. The 3 ETFs that I'm going to pick: for the domestic stock market, I'm picking VAS, Vanguard Australian Shares Index ETF. For the international stock market, I'm picking VGS, Vanguard MSCI Index International Shares ETF. For the bond, I'm picking VAF, Vanguard Australian Fixed Income Index ETF. If you think VGS doesn't cover the emerging markets, feel free to share some of its weights to VGE, which is Vanguard FTSE Emerging Markets Shares ETF. That will make you 4 fund portfolio. Or if you want to seek ultimate 1 fund portfolio, that's doable as well. You can pick one of the 4 Vanguard diversified index ETF from conservative, balanced, growth, and high growth. And these funds predetermined asset allocation from global bonds, Australian stocks, cash, international stocks, emerging market shares, international small companies shares. Of course, the drawbacks of these 4 diversified ETFs is the asset allocation is predetermined. It may not be the optimal option to suit your own financial goals and risk tolerance. So we got 25% in VAS and 45% in VGS and 30% in VAF. Let's look at the returns first. The 1-year, 3-year, 5-year annualized returns are all slightly lower than the weighted index benchmarks. As we see, the excess returns are all negative. And let's look at the volatility. So the standard deviation is a measure of how spread out the numbers related to its means. So it's often used to indicate the market volatility. We can see it's similar to its weighted index standard deviation, as all of the 3 holdings are all index funds. So the Sharpe ratio, it describes how much excess return you receive for the extra volatility you endure for holding a riskier asset. So a Sharpe ratio of 1 is considered acceptable, and 2 is considered very good. A 3 is considered excellent. We can see the last year's portfolio Sharpe ratio provides a really good risk-adjusted return for this portfolio. And now let's look at the risk and return analysis. When we construct a portfolio, we all want it to be efficient, which means for a given level of risk, it provides the maximum return it can be. If you look at VGS and VAS, based on the historical data we are testing, which is 5 years back, VGS, which is the number 1 here, is a better investment than VAS because it's less volatile but provides better return. By adding an international stock index fund, VGS, and a different asset class, Australian bonds, our portfolio is doing better than having VAS alone. Well, let me know, how did you construct your portfolio and how many funds are there in your core investments? Are there 1, 2, 3 or more? Well, I hope you grabbed the information that you were looking for, and I'll see you guys in my next video. Bye.